In the world of finance, the word mania is a weapon. It is used to dismiss rallies. It is used to frighten savers. It is used to convince you that the asset you hold is about to crash. Right now, as gold breaks nominal records and silver shows flashes of extreme volatility, the headlines are screaming that word again. They tell you we are in a bubble. They tell you it is 1980 all over again. They tell you to sell before the inevitable collapse. But history tells a different story. If you look at the raw data, not the nominal numbers on the ticker, but the real inflation-adjusted mathematics of value, you will find that we are not at a peak. We are not even close to a mania. What we are witnessing is something far more profound and far more durable. It is what financial historians call a structural acceleration. It is a revaluation of real assets in a world where paper promises are losing their meaning. Welcome to the Financial Coin Historian. Today we are going to conduct a forensic audit of the precious metals market. We will strip away the fear and look at the cold, hard facts. We will travel back to the Hunt Brothers' silver corner of 1980 and the quantitative easing rally of 2011 to show you exactly what a bubble looks like and why today looks nothing like them. We will examine the whales that are buying gold today, not retail speculators, but sovereign central banks. And we will analyze the gold to silver ratio to reveal why silver, far from being expensive, is historically cheap. This is the definitive answer to the question, is this a gold and silver mania? To understand where we are, we must first understand where we have been. To diagnose a mania, we must look at the patient who actually died from one. The year was 1980. The asset was silver. The Hunt Brothers Corner. The 1980 silver spike is the textbook definition of a speculative mania. But it was not driven by natural market forces. It was driven by a specific targeted event, the attempt by the Hunt brothers, Texas oil tycoons, to corner the global silver market. They bought physical silver. They bought futures contracts. They leveraged their immense fortune to squeeze the available supply. This created a feedback loop of panic and greed. Retail investors lined up around the block to sell their silverware to refineries. The price of silver shot up to a nominal high of $49.45 per ounce. But here is the crucial data point that modern analysts ignore. That $49.45 in 1980 is not the same as $50 today. The inflation-adjusted reality. If we adjust that 1980 peak for the inflation we have experienced over the last 45 years, using even the government's own conservative numbers, the real peak of silver in 1980 was not $50. It was $199 per ounce. Let that sink in. In purchasing power terms, silver would have to quadruple from its current levels just to match the high it set nearly half a century ago. When an asset is trading at 25% of its inflation-adjusted all-time high, you cannot call it a bubble. A bubble is when prices detach from reality and soar beyond historical norms. Silver today is not detached from reality. It is arguably the most undervalued asset on the planet relative to its own history. The 1980 crash was sharp and immediate because it was built on leverage and manipulation. Once the regulators stepped in and changed the margin rules, the Hunt brothers were forced to liquidate and the price collapsed. That is the anatomy of a mania, a vertical spike followed by a vertical crash. That is not what we are seeing today. The next major peak occurred in 2011. This was different from 1980. It wasn't about two brothers trying to corner a market. It was a reaction to systemic failure. Following the 2008 global financial crisis, central banks unleashed quantitative easing, QE. They printed trillions of dollars to buy bad debt. Investors, fearing the debasement of the currency, fled into gold and silver. Silver reached a nominal peak of $48.70 per ounce. Gold touched $1,920. But again, we must look at the real value. Adjusted for inflation, the $48.70 peak in 2011 is equivalent to approximately $72 per ounce in today's money. Current silver prices are trading significantly below this level. We have not even breached the purchasing power high of the last cycle, let alone the historic mania of 1980. The 2011 cycle ended because central banks managed to convince the world that they could normalize interest rates and shrink their balance sheets. They promised a return to normalcy. Today, that promise is broken. The balance sheets are permanently expanded and the debt is mathematically unpayable. The drivers of 2011, fear of currency debasement, are back, but they are now joined by something new, something structural. If this isn't a mania, what is it? It is a structural acceleration. A mania is driven by retail investors, taxi drivers, shoe shiners, and your neighbors, speculating with borrowed money because of fear of missing out, FOMO. That is not who is driving the gold price today. The sovereign bid. The current rally is being led by the largest, most conservative institutions in the world, central banks. For 3 consecutive years, 2022, 2023, and 2024, global central bank gold buying has exceeded 1,000 tons. This is accumulation on a scale unseen in modern times. Why are they buying? They are not speculating on price. They are hedging against geopolitical risk. They are diversifying away from the US dollar. After the freezing of Russia's foreign reserves in 2022, every nation outside the Western alliance realized that dollar reserves are not a safe haven. They are a political liability. This creates a sovereign price floor. In a retail mania, when the price drops, panic sellers rush for the exit, causing a crash. In a structural bull market led by central banks, when the price drops, sovereign nations buy the dip. They absorb the supply. This provides a resilience that bubbles do not possess. The shift from equities. We are also witnessing a structural rotation of capital. The gold to S&P 500 ratio has broken out of a multi-year downtrend. This signals that large-scale institutional assets, pension funds, sovereign wealth funds, are beginning to underweight traditional stocks and overweight hard assets. This is reminiscent of the early 1970s. It is a slow, grinding shift of titanic amounts of capital. This is not hot money chasing a quick profit. It is smart money seeking long-term preservation. Perhaps the strongest evidence that we are not in a mania lies in the relationship between gold and silver. Historically, silver acts as a parabolic amplifier. In the final stages of a precious metals bull market, silver outperforms gold dramatically. Retail investors, priced out of gold, flock to the poor man's gold, sending its price vertical. We track this using the gold-silver ratio. This number tells us how many ounces of silver it takes to buy 1 ounce of gold. In the 1980 mania, the ratio collapsed to 17.1. Silver was incredibly expensive relative to gold. In the 2011 peak, the ratio fell to roughly 30.1. Today, the ratio sits at approximately 73.1. What does this mean? It means silver is priced at only 1.2% of the price of gold. It is historically cheap. In a true mania, we would expect this ratio to be collapsing toward 30 or even 20. The fact that it remains so high indicates that the speculative fervor has not yet arrived. If the ratio were merely to revert to the 2011 average of 31, assuming gold stays flat, silver would need to more than double in price. The immense latent energy in this ratio suggests that the hyper-parabolic phase for silver is still ahead of us. Technically, the market structure confirms the structural acceleration thesis. Gold has resolved a multi-year consolidation base. Think of a coiled spring. For years, the price was compressed below resistance levels. When it finally broke out, it didn't shoot up in a straight line like a bubble. It began a measured, powerful ascent. Analysts comparing the current cycle to the 1970s find striking similarities. Breakout velocity. The monthly gains align with the early acceleration phase of the 1970s, not the terminal exhaustion phase. Volume expansion. Current volume is running at about 3.2 times the average. This signifies strong institutional accumulation. In a blow-off top, volume typically explodes to 5 or 10 times the average as the public piles in. We are not seeing that yet. Unlike 1980, which relied on market manipulation, or 2011, which relied on a temporary policy response, the current cycle is fueled by fundamental multi-year drivers. Fiscal dominance. The U.S. debt is growing at a rate that makes it mathematically impossible to repay in real terms. The only way out is financial repression, keeping interest rates below inflation. This is the perfect environment for gold. Physical scarcity. Inventories in the Shanghai Futures Exchange have dropped to decade lows. The industrial demand for silver, for solar panels, electronics, and green energy is colliding with stagnant mine supply. We are facing a physical deficit. Monetary pivot. The Federal Reserve is cutting rates. Historically, as real interest rates fall, the opportunity cost of holding non-yielding assets like gold drops, fueling price appreciation. So, if this isn't the top, what does the top look like? When should we actually be worried about a mania? History gives us 3 clear signals to watch for. Valuation reversion. Silver needs to breach the inflation-adjusted 2011 high of $72 and start moving toward the 109 level of 1980. Ratio collapse. The gold-silver ratio must crash below 30. 1. This would signal that silver has become overextended relative to gold. The premium spike. Watch the physical market. In a mania, the paper price cannot keep up with physical demand. Premiums on coins and bars will spike to 30%, 40%, or even 50% over spot price as retail panic sets in. Until we see these signs, the trend remains upward. The media will continue to call it a bubble. They will try to scare you out of your position every time there's a correction. But the financial historian knows better. We know that 1980 was a manipulation. We know that 2011 was a reaction. And we know that what is happening now is a structural realignment of the global financial order. The central banks are buying because they know the dollar system is fraying. The institutions are buying because they know inflation is sticky. And the smart money is buying because they know that $50 silver is, in real terms, a bargain. This is not a mania. It is the sound of money returning to its true value after decades of suppression. The acceleration has begun. The question is not whether the price will crash, but whether you will be holding real assets when the rest of the world finally realizes what is happening. This is the financial coin historian. History has shown us the pattern. Now it is up to you to read the signs.